Warren Buffett has made one of the biggest bets of his career, and a lot of investors have just completely ignored it or missed it. And in this video, I'm going to talk about how Warren Buffett has bought nearly $60 billion worth of Berkshire Hathaway stock. So this is a share buyback that he's done over the last few years, arguably the biggest bet of his career. And so I think it's important to understand how is Warren Buffett thinking about Berkshire Hathaway's valuation and why he thinks it's potentially compelling. And so we'll walk through sort of what's driving Berkshire Hathaway, as well as the valuation, framework, the hypothetical valuation framework, where I consider, what's the upside potential from here. And I'm also going to talk about why I think it has the potential to outperform, let's say, the major U.S. indices in the years ahead. So let's dive right in to understand this dynamic. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. So, trying to understand this, a lot of folks love to check out what's his latest purchase, maybe small, maybe big. Chevron is quite interesting, nearly $20-30 billion purchase. Activision Blizzard, that's a merger arbitrage play, $5-6 billion. I did a whole other video on his recent transactions. And, some folks might say, well, Daniel, isn't Apple his biggest bet? It's nearly $200 billion market, valuation of their bet, but on a cost basis, it's closer to $30 billion. Now, you see, by far on a cost basis, that's the biggest of his different bets. But when you actually look at the last few years, the reality is their largest bet has been in buying back Berkshire Hathaway stock. In just the last 3 years, they've purchased nearly $60 billion, $27 billion last year, $25 billion the year before that, $5 billion the year before that. And starting this quarter, first quarter 2022, another $3 billion buybacks. This is nearly $60 billion. That's a huge investment, $60 billion cost basis, relative to all these other bets that they've considered. So this raises the question, what is Berkshire Hathaway worth? What does Warren Buffett see in the current valuation? And why do I think it still has the potential to outperform the U.S. indices in the years ahead? So a lot of folks might look at their earnings and say, oh my goodness, their earnings are falling apart. You see the first quarter 2022, $5.5 billion in net earnings attributable to Berkshire shareholders, down from nearly $12 billion the prior year. Do you really want to invest in a company with that sort of decline? And the reality is that you need to peel it back a little bit and realize that there's different components here. You have operating earnings from the businesses that they own, and then you have changes in their investment portfolio that gets reflected into their earnings. And so last year during the first quarter, they effectively benefited $4.7 billion from investments in derivatives. This year, it's about $1.6 billion loss during the first quarter, and that's why you see that fluctuation. Their operating earnings were actually about flat year over year. And so what drives their earnings longer term, and what's driving this business? First, one should understand insurance. Geico is their most profitable of their different insurance operations, the auto insurer. However, they also have basic property and casualty insurance as well as reinsurance operations. Reinsurance has been unprofitable for years. So you look at their underwriting results based on the insurance that they write out, the policies that they write, and it's been around $1 billion to $2 billion in profitability. However, the vast majority of their economics from their insurance operations comes from the investment income. So the dividends, effectively the investment income that's generated from their float. So whenever they write an insurance policy, they get a hold on to that cash, and they constantly, yes, you do pay out claims over time, but you're also constantly writing new policies. So that's this float that you get a hold on to, and you get it reinvested into opportunities or equities or bonds. And so the income that those equities and bonds, the dividends or the interest payments from those bonds, that's represented in this float investment income I'm calling out. And you can see that has been rising. It's around $5 to $6 billion per year, and that is levered to higher interest rates over time. So they do benefit from that because they have sizable cash balances that will directly benefit this business over time. Now, also, I do wonder, is it possible that their reinsurance operations could be closer to break even over time? So based on looking at where these different operations have been over time, looking at, their different, primary versus reinsurance operations, maybe this segment could generate $10 billion in profitability somewhere in the years ahead. This is how I'm sort of thinking about base case sort of valuation, framework is what's the earnings power from these different segments. And you can see over the last few years, it's somewhere between $6.5, $8 billion in earnings power. This pre-tax earnings power from their insurance operations. So then next you look at their non-insurance segments. A lot of these are operational industrial companies like Burlington Northern Santa Fe Railway. That's generating meaningful amounts of profitability, somewhere between $7 billion and $8 billion in operating profit each year, growing nicely each year. You look at Berkshire Hathaway Energy, that's around $3 billion in profit. There are various different manufacturing, like precision cast parts, critical parts that go into the jet engines for planes. That's, there's only a few players like precision cast parts or Lubrizol specialty chemicals. That's what you're looking at for manufacturing. You have McLean, which is a shipping or transportation company, as well as service and retailing. And this just represents literally dozens of different assets. It might be See's Candy, it might be Fruit of the Loom. It includes a lot of different things. And this is, at the end of the day, Berkshire Hathaway is a conglomerate. You have a lot of dozens and dozens of different companies under the Berkshire Hathaway umbrella. And so this is sort of piecing it all together in terms of thinking about, okay, these are the different components. So you saw previously, okay, maybe, looking at this, you're thinking maybe their non-insurance segments can generate around 20 to 25, $26 billion in operating profit. So this is once again pre-tax, thinking about what's the profitability long-term for these different segments. So then that leaves the last component, which is their equity or their investment portfolio. That includes equities and bonds. And this can fluctuate dramatically in any given year. 2018, it lost $22 billion. 2019 and 2020, 2021, each huge years, $72 billion appreciation, $41 billion appreciation. $78 billion appreciation. So you see, this will fluctuate around a lot. The way to consider it is it's really these different components. You're always going to have a large amount of cash on their balance sheet because this is an insurance operation and they need to have that 30, 40 billion at least on their balance sheet. And Buffett has called that out. So then you look at what could potentially appreciate over time. What's going to change? This is not investment income I'm focused on, which I already covered, generates, let's say, $6 billion in pre-tax profit. The question is, what's the change in value for their equity investments like Apple? So that's, you look at their equity investments as of the first quarter 2022, you're looking at nearly $400 billion in stocks. Then you layer on another fact that they have about $70 billion in cash, another $20 billion in bonds, another $18 billion in effectively private equity securities. So all in, you're looking at nearly $500 billion worth of securities. What do you think that's going to appreciate at over time? And so if you think that it's going to be somewhere mid-single digits increase over time, then you're looking at around $35 billion increase pre-tax. Thinking about this business operation of what this could do, how this could translate into earnings. So when you consider, factoring in insurance, factoring in their manufacturing, and factoring in the change in their portfolio, maybe on average, sort of a normalized earnings power for Berkshire right now might be around $50 billion. In which case you're looking at a company, now keep in mind that there's a lot of assumptions that go into that, like, hey, what's this investment portfolio going to do actually over time? And one year it might be hugely positive, another year it might be hugely negative. And that's why I called it out. At one point it might be down 20 billion, it might be down 30, 100 billion. Another year it might be up 100 billion. So you're going to see huge fluctuations that go into this. But when you layer in, okay, here's the insurance operations, here's the non-insurance operations, and here's what I think their portfolio could appreciate at over time, assuming some sort of multiple, you layer in each of these different things, and you say, okay, maybe the earnings power for Berkshire Hathaway is around $50 billion right now, which is quite sizable. I mean, when you think about just how big that is, and that implies relative to their $700 billion market cap. So I throw out three different scenarios saying, hey, this is where we currently are. It's currently around $700 billion market cap, currently around $318 per B share. What's the different range of normalized earnings power? So saying somewhere between 45 billion and 55 billion, which implies it's trading somewhere around a low teens to a mid-teens earnings multiple. And what's the growth rate for their core earnings going forward? Okay, well, maybe it's 6%, 8%, 10% based on, low to high. Trying to think about what's the upside potential from here over the next 5 years, trying to think, what's reasonable framework to consider their businesses could grow at in the years ahead. And this also includes, what do I think their portfolio could potentially grow at in the years ahead, because that definitely impacts this normalized earnings figure. And so thinking about that, that means if you compound at 6% over the next 5 years, it's closer to 60 billion in earnings potential 5 years from now, which means it's only going to trade at, let's say, 5 times at the current market cap of $700 billion. That's only around 12 times forward earnings multiple 5 years forward. And so if you assume 5 years from now it just trades at 12 times, then that effectively implies that you're looking at a return of around break even plus whatever cash gets sort of accrues to you. And this gets to the point of, well, if management's buying back stock meaningfully, like they have been the last few years, that could, if you see Buffett continue to buy significant amounts of stock, which he could, given that his businesses do generate 30-40 billion in free cash flow a year, what you're looking at is, this could be shrinking the pie each year. So the number of shares outstanding decline. So even if the market cap is roughly the same at, let's say, 722 billion, you could still have a nice return because or an adequate. I wouldn't exactly say a 4% annualized return is great, but I'd say this is reasonable. It's not crazy good, but I do think relative to the S&P 500, this is relatively more attractive, given that let's consider the S&P 500 for a second. Let's think about this. So Berkshire Hathaway, if you compare it relative to where the S&P 500 was, let's say prior earnings peak in 2006, and you compare Berkshire Hathaway's earnings growth, it looks like Berkshire's growing faster, and yet Berkshire also trades at a lower earnings multiple. So that is really interesting development, because let's say the S&P 500 currently trades around 21 times earnings. You compare that, now that's current earnings, you compare that to maybe 18 times for the S&P 500 if you say forward earnings. Now you look at what Berkshire's doing, and Berkshire's arguably somewhere in low teens. So the question is Berkshire really going to underperform the fundamental earnings growth for the S&P 500 in the years ahead? And I don't, personally, I don't think so. So does it make sense for, let's say Berkshire to have a discounted valuation? What if in 5 years from now, they both end up around a teens valuation? Well, for the S&P 500, that would be a real headwind, because you're starting at, let's say, 20 times earnings and going down to 15 or 16 times earnings 5 years from now. That's a headwind that you would be fighting. Whereas for Berkshire, it's a nothing burger, because their current valuation is around that, potentially lower. So if anything, if Berkshire's valued around a teens earnings multiple, mid-teens earnings multiple 5 years from now, both the S&P and Berkshire, then for the S&P it could be a headwind, and for Berkshire it could be a tailwind, looking at this current valuation framework. So you get this aspect where if earnings grow in line with the S&P 500 or better, plus you have this dynamic of you might also get valuation expansion relative to the S&P 500, which trades at a premium multiple relative to Berkshire. So you have some of the best capital allocators in the world, Buffett and Munger. Arguably they're getting old, and there's a good chance they won't even be around 5 years from now, but they're picking really smart, really clever, intelligent capital allocators, intelligent business operators. So you should, at least I think, that they could potentially continue to execute and do well in the years ahead. Now, keep in mind, none of this is financial advice. This is, whenever I'm looking at a hypothetical framework, of course, stock price can go way higher or way lower. A lot depends on that execution. How do they deliver? So I'm looking at this framework, and look, I'm not personally pulling the trigger on Berkshire Hathaway here, even though I think it could do fairly well. But effectively, it's saying over the next 5 years, it could potentially compound at, let's say, 5% annualized to a high teens rate. Relative to the S&P 500, I find that to be pretty attractive, because I think the S&P 500 is starting at a much higher multiple than, let's say, the teens here, that the mid-teens here, mid to low teens that you're looking at with Berkshire, and it might have lower growth than what you could have for Berkshire. So that's higher valuation, lower growth. That doesn't smell good for the S&P 500. So I'm personally not buying Berkshire, because personally I'm looking for potential multi-baggers. Berkshire's already a $700 billion company. I want to try to find things that can go up several 100% in the years ahead. I call out ideas each week at Unrivaled Investing, weekly, letter. If you're looking for potentially actionable ideas, things that you could buy today, that's what I'm trying to call out with this letter. There's also a community of investors looking to learn and share their thoughts that you can join in as well. Once again, that's unrivaledinvesting.com. I recently overhauled the website so that it's much easier to find the content, see how it's organized by idea, and it's also cheaper. So you can check that out if you're interested at unrivaledinvesting.com. If you enjoyed this video talking about Berkshire Hathaway, think about how Berkshire Hathaway can compound in the years ahead, and as well as how this is arguably the biggest bet of Warren Buffett's career in buying back Berkshire Hathaway stock, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.